Hi there, in this video, you'll learn how the £3,000 CGT allowance fits into divorce settlements and property transfers.
Welcome to this explainer, brought to you by My Tax Accountant, or MTA. We're your trusted UK accounting firm, and we help people confidently navigate the often murky waters of tax compliance. Today, we're diving into something super specific, but honestly, absolutely crucial: divorce settlements and the capital gains tax allowance. Now, I want to speak directly to a very specific viewer today. If you're a UK homeowner, maybe a higher rate taxpayer, and you're currently going through a permanent separation, well, this is for you. Splitting a life apart is emotionally exhausting, but without the right guidance, it can be incredibly financially exhausting too.
£3,000. Let that sink in for a second. For the 2026-27 tax year, this shockingly low figure is your entire capital gains tax annual exempt amount. Literally, that is the absolute maximum profit you can make on the disposal of an asset before HM Revenue and Customs steps in to take their cut.
So, you've got to ask yourself, could your divorce settlement accidentally trigger a massive tax bill? Well, picture this scenario. You and your ex-partner jointly own a buy-to-let property here in the UK, or maybe you've built up a healthy portfolio of shares. As part of the settlement, you decide to transfer your share of those assets to your ex. Because that annual allowance is so painfully low right now, transferring those assets at the wrong time or without the proper legal framework, it could immediately trigger a huge capital gains tax bill. It would literally drain the very wealth you're trying to divide. The question is, are you prepared for these strict rules?
Don't worry, we're going to map all of this out for you today so you don't fall into this trap. We'll start by looking closely at the £3,000 tax trap itself, then we'll move into the 3-year transfer window and the absolute power of court orders. After that, we'll cover protecting the family home, how to perfectly time your asset transfers, and finally what your next step should be with MTA.
Okay, let's dive straight into our first point.
The sheer contrast between the past and our current 2026/27 reality is, quite frankly, staggering. Just think back a few years to 2020. The annual exempt amount was a pretty generous £12,300. Today, it's frozen at a strictly limited £3,000. So why does this matter to you? Well, when you transfer an asset to a separated spouse outside of protected timeframes, HMRC actually treats it as if you sold that asset at market value. And with an allowance of only £3,000, it's easier than ever to get caught out and taxed on that gain.
Let's look at the harsh financial reality here. If you're transferring residential property, say a buy-to-let flat or second home, any gain above that tiny £3,000 allowance is going to be taxed. If you're a basic rate taxpayer, you're looking at an 18% tax hit. And if you're a higher or additional rate taxpayer, you'll be paying 24% on those gains. To put that into perspective, imagine your share of a property has a $53,000 embedded gain. You deduct your $3,000 allowance, leaving $50,000 completely taxable. Losing 24% of that means handing $12,000 straight over to HMRC. That is a massive chunk of your divided wealth just gone.
So, how do we avoid this? That brings us to our next critical point.
The absolute most crucial thing you need to understand is the transfer timeline. In the UK, transfers between spouses who live together happen on what we call a no-gain, no-loss basis. That means no immediate tax is due. The recipient simply inherits the original purchase cost. But the very moment you permanently separate, a clock starts ticking. Under the updated rules, here's exactly how it works. First, you pinpoint the date of separation. The clock actually begins ticking at the end of the tax year in which you separated. From that specific point, you have exactly 3 full tax years to transfer assets between yourselves on a completely tax-free, no-gain, no-loss basis. So, for example, if you separate in June 2026, the tax year ends on the 5th of April 2027. You then have 3 full years, all the way until the 5th of April 2030, to finalize your transfers without triggering a CGT bill.
Now here's a professional tip straight from the tax experts at MTA. If, for whatever reason, you're making transfers that fall completely outside this protected window, or maybe you're selling assets to third parties to fund a settlement, try to stagger your disposals across different tax years. Because that £3,000 allowance is per person per tax year, careful timing actually allows both spouses to utilize their individual allowances. It's a really smart way to potentially save yourselves a tidy sum.
But what if 3 years just isn't enough time? Let's talk about the ultimate safety net.
We all know divorces can be incredibly complex. Trying to sort out asset valuations, child custody, all the legal back and forths, it can very easily push a settlement way past that 3-year deadline. But here is the game changer. If your transfer is part of a formal divorce agreement or a court order, which is often called a consent order, you are granted unlimited time to make those no-gain, no-loss asset transfers. Securing a formal consent order literally removes the deadline entirely. It gives you absolute bulletproof tax protection for delayed settlements. Without it, the second that 3-year window closes, you're entirely exposed to market value taxation.
Let's shift gears slightly and talk about the biggest asset for most separating couples.
Usually, when you sell your main home, it's completely tax-free, right? That's thanks to private residence relief, or PRR. But what happens when one spouse moves out during a separation? Under the old rules, the departing spouse would actually start losing that tax relief because the property was no longer their main home. However, thanks to some really welcome reforms introduced in April 2023, there's a brilliant safety net. If you were the departing spouse, as long as the property remains the main home of your ex-partner, and you haven't elected a new property as your main tax residence, you still qualify for full private residence relief on your share of the property when you eventually transfer it to them as part of a formal agreement. Meaning, it's completely protected from those brutal 18% or 24% tax rates. Now, sometimes you just don't want to sell or transfer immediately. Maybe you want to keep the kids in the family home until they finish school, which is super common. This is usually structured as a mesher order, which is essentially a deferred sale. The departing spouse moves out, but they retain an interest in the home, entitling them to a share of the proceeds when it is finally sold years down the line. The brilliant news here is that if this deferred sale is part of a formal divorce agreement, the departing spouse's eventual payout is safely shielded. They can claim PRR on their share of the eventual sale proceeds in the exact same proportion that would have applied had they transferred it on the very day they moved out. But I really need to share an urgent did you know insight with you right now. If you do end up selling a UK residential property and there actually is capital gains tax to pay, maybe it was a second home or you just didn't qualify for full relief, you must report and pay that estimated CGT to HMRC within a strict 60 days of completion. Not the exchange of contracts, mind you, but completion. Missing this 60-day reporting deadline means immediate late filing penalties and interest on unpaid tax. Honestly, it catches so many people out, so write that one down.
Okay, so how do we put all this theory into practice? Let's look at the real-world impact of everything we've just discussed, and this table brilliantly illustrates the point. Imagine you're transferring a jointly owned buy-to-let flat to your ex-spouse. If you time this transfer inside that 3-year window, your CGT liability at the point of transfer is exactly 0. The gain is fully deferred under the no gain, no loss rule. But look at the bottom row. If you make the exact same transfer outside that window and you don't have a formal court order, boom, you are hit with 18% or 24% tax on any gain above your tiny £3,000 personal allowance. The asset is exactly the same. The only difference is your timing and your legal structuring.
So how do we actually action this? Well, here is the step-by-step action plan we recommend at MTA to legally protect your assets. Step 1, identify all your assets and their embedded gains. Look at your properties, your share portfolios, your business assets. Note down their original purchase cost and their current market value. Step 2, confirm your exact separation date. This is absolutely critical because it dictates exactly when your 3-year window ends. And Step 3, obtain a formal consent order. Please, do not rely on informal agreements. Getting a court-approved agreement is literally the only way to secure unlimited time for tax-free transfers and to protect deferred sales of the family home.
Let's talk about where you go from here.
Listen, you absolutely do not need to navigate this stressful process alone. UK tax rules are rigid, and as we've seen with the £3,000 allowance and those strict 60-day reporting deadlines, HMRC leaves very little room for error. I highly urge you to reach out to the specialists at My Tax Accountant. You can call the team directly on 0208-570-8531, drop an email to info@mytaxaccountant.co.uk, or visit the website at www.mytaxaccountant.co.uk. And of course, please don't forget to subscribe to the MTA YouTube channel for more expert explainers just like this one.
As we wrap up, I want to leave you with one final provocative question. Have you calculated the true after-tax value of your divorce settlement? Remember, dividing assets 50-50 on paper really doesn't mean much if one of you inherits a massive embedded tax liability while the other walks away free and clear. Do not ignore the reality of this £3,000 allowance. Take immediate action, secure your consent orders, and get professional advice.
Finally, just a quick reminder that this explainer is strictly for general educational and informational purposes only. It doesn't constitute financial, legal, or tax advice. The UK tax rules we've discussed apply to the 2026/27 tax year, And of course, individual circumstances can vary greatly. Always consult with a qualified professional, like the team at MTA, regarding your specific situation. Thank you so much for joining me today, and I wish you all the absolute best in confidently managing your financial future.